Sison versus Ancheta, 130 Squa 654. Facts. Antero Sison Jr. filed a case for declaratory relief or prohibition proceeding against BIR, Acting Commissioner Ancheta. He challenges the validity of Section 1 of BP 135, which further amends Section 21 of the 1977 NIRC. Section 21 provides for rates of tax on citizens or residents on a. Taxable compensation income, taxable net income, royalties, prices and other winnings, interest from bank deposits and yield, or any other monetary benefit from deposit substitutes and from trust funds and similar arrangements. E. Dividends and share of individual partner in net profits of taxable partnership, adjusted gross income. Sison alleges that Section 21 violates the Due Process and Equal Protection Clause and also the rule on uniformity of taxation. He would be discriminated against by the imposition of higher rates of tax upon his income arising from the exercise of his profession than that imposed upon fixed income or salaried individual taxpayers. He asserts that they are arbitrary, amounting to class legislation, oppressive and capricious. Issue: whether Section 1 of BP 135, which imposes a higher tax on taxable net income derived from business, profession, that on compensation, is constitutionally infirm. Held: no. The Supreme Court ruled that because the field of state activity has assumed a much wider scope, there is need for more revenues. The power to tax, an inherent legislative scope or prerogative, has to be availed of to assure the performance of vital state functions. Taxes being the lifeblood of the government, their prompt and certain availability is of the essence. As Justice Malcolm said, the power to tax is an attribute of sovereignty. It is the strongest of all powers of the government. But the power to tax is not unconfined. There are restrictions set forth by the Constitution. Both Due Process and Equal Protection Clause may properly be invoked, as Sison does in this case, to invalidate a revenue measure. If it were otherwise, there would be truth to the Marshall dictum that the power to tax involves the power to destroy. However, Holmes' dictum is adopted in the Philippines. The power to tax is not the power to destroy, while this court sits. Philippine Healthcare Providers versus CIR, September 18, 2009. Facts. Respondent CIR sent petitioner assessment of deficiency taxes, both VAT and documentary stamp tax, DST, in the amount of 224,702,614.18 cents for taxable years 1996 and 1997. Petitioner protested such assessment in a letter, but the respondent did not act on the protest, which led the petitioner to file a petition in the CTA, seeking the cancellation of said assessments. CDA partially granted the petition, wherein the petitioner is ordered to pay the deficiency VAT and set aside the DST deficiency tax. Respondent appealed in the CA. With regard to the cancellation of DST assessment, CA granted the petition. The court affirmed CA's decision. Hence, petitioner filed motion for reconsideration. Issue: whether the petitioner is liable to pay the DST on its health care agreement pursuant to Section 185 of the NIRC of 1997. Held: petition granted. Petitioner is not contemplated to be included in or other branch insurance covered by Section 185 of NIRC because it is a health maintenance organization or HMO and not an insurance company. In fact, a substantial portion of petitioner's services covers preventive and diagnostic medical services intended to keep members from developing medical conditions or diseases. As an HMO, it is its obligation to maintain good health of its members. Accordingly, its healthcare programs are designed to prevent or to minimize the possibility of any assumption of risk on its part. Thus, its undertaking under its agreement is not to indemnify its members against any loss or damage arising from a medical condition, but on the contrary, to provide the health and medical services needed to prevent such loss or damage. Moreover, HMO play an important role in society as partners of the state in achieving its constitutional mandate of providing citizens with affordable healthcare services. As a general rule, the power to tax is an incident of sovereignty and is unlimited in its range, acknowledging in its very nature no limits, so that security against its abuse is to be found only in the responsibility of the legislature, which imposes the tax on the constituency who is to pay it. So potent indeed is the power that it was once opined that the power to tax involves the power to destroy. Commissioner versus Algue. Facts. The Philippine Sugar State Development Company, PSEDC, appointed Algue Incorporation as its agent, authorizing it to sell its land, factories, and oil manufacturing process. The Vegetable Oil Investment Corporation, VOICP, purchased PSEDC properties. For the sale, Algue received a commission of $125,000, and it was from this commission that it paid Guerrera et al., organizers of the VOICP, $75,000 in promotional fees. In 1965, Algue received an assessment from the CIR in the amount of $83,183.85 as delinquency income tax for years 1958 to 1959. Algue filed a protest or request for reconsideration which was not acted upon by the BIR. The counsel for Algue had to accept the warrant of distraint and levy Algue. However, filed a petition for review with the CTA. Issue: whether the CIR correctly disallowed the $75,000 deduction claimed by Algue as a legitimate business expense in its income tax return. Held: no. Claim deduction was an ordinary reasonable business expense. Amount has been legitimately paid by Algue for actual services rendered. The payment was in the form of promotional fee and collected by the payees in the creation of VOIC and the subsequent purchase of the properties of the PSEDC. Algue has proved that the payment of fees was necessary and reasonable in the light of the efforts exerted by the payees in including investors and prominent businessmen to venture in an experimental enterprise and involve themselves in a new business requiring millions of pesos. It is said that taxes are what we pay for civilized society. Without taxes, the government would be paralyzed for lack of the motive power to activate and operate it. Hence, despite the natural reluctance to surrender part of one's hard-earned income to the taxing authorities, every person who is able to must contribute his share in the running of the government. The government, for its part, is expected to respond in the form of tangible and intangible benefits intended to improve the lives of the people and enhance their moral and material values. This symbiotic relationship is the rationale of taxation and should dispel the erroneous notion that it is an arbitrary method of exaction by those in the seat of power. But even as we concede the inevitability and indispensability of taxation, it is a requirement in all democratic regimes that it be exercised reasonably and in accordance with the prescribed procedure. If it is not, then the taxpayer has a right to complain and the courts will then come to his succor. For all the awesome power of the tax collector, he may still be stopped in his tracks if the taxpayer can demonstrate, as it has here, that the law has not been observed. We hold that the appeal of the private respondent from the decision of the petitioner was filed in time with the respondent court in accordance with Republic Act No. 1125, and we also find that the claim deduction by the private respondent was permitted under the Internal Revenue Code and should therefore not have been disallowed by the petitioner. Napocor versus City of Cabanatuan. April 9, 2003. Facts. Napocor is a GOCC created under CA 120 as amended. It sells electric power to the residents of Cabanatuan City, boasting a gross income of 107,814,187.96 cents in 1992. Pursuant to Section 37 of Ordinance Number 165-92, the respondent assessed the petitioner a franchise tax amounting to 808,606 representing 75% of 1% of the latter's gross receipts for the preceding year. Petitioner whose capital stock was subscribed and paid wholly by the Philippine government refused to pay the tax assessment. It argued that the respondent had no authority to impose tax on government entities. Petitioner also contended that as a nonprofit organization, it is exempted from the payment of all forms of taxes, charges, duties, or fees in accordance with Section 13 of Republic Act No. 6395 as amended. Section 13, Nonprofit Character of the Corporation, Exemption from all taxes, duties, fees imposed, and other charges by government and government instrumentalities. The corporation shall be nonprofit and shall devote all its return from its capital investment as well as excess revenues from its operation for expansion, to enable the corporation to pay its indebtedness and obligations, and in furtherance and effective implementation of the policy enunciated in Section 1 of this Act, the corporation is hereby exempt from, letter A, the payment of all taxes, duties, fees, imposed charges, costs, and service fees in all court or administrative proceedings in which it may be a party, restrictions and duties to the Republic of the Philippines, its provinces, cities, municipalities, and other government agencies and instrumentalities. B. From all income taxes, franchise taxes, and realty taxes to be paid to the national government, its provinces, cities, municipalities, and other government agencies and instrumentalities. C. From all import duties, compensating taxes and advance sales tax, and wharfage fees on import of foreign goods required for its operations and projects. And D. From all taxes, duties, fees imposed, and all other charges imposed by the Republic of the Philippines, its provinces, cities, municipalities, and other government agencies and instrumentalities. On all petroleum products used by the corporation in the generation, transmission, utilization, and sale of electric power. The respondent filed a collection suit in the Regional Trial Court of Cabanatuan City, demanding that petitioner pay the assessed tax due, plus the surcharge equivalent to 25% of the amount of tax and 2% monthly interest. Respondent alleged that petitioner's exemption from local taxes has been repealed by Section 193 of Republic Act No. 7160. RTC upheld NPC's or Napocor's tax exemption. On appeal, the CA reversed the Regional Trial Court's order on the ground that Section 193 in relation to Sections 137 and 151 of the LGC expressly withdrew the exemptions granted to the petitioner. Issue: whether City Government of Cabanatuan has the authority to issue Ordinance No. 165-92 and impose an annual tax on business enjoying franchise. It is beyond dispute that the respondent city government has the authority to issue Ordinance No. 165-92 and impose an annual tax on business enjoying a franchise pursuant to Section 151 in relation to Section 137 of the LGC. Section 137, Franchise Tax. Notwithstanding any exemption granted by any law or other special law, the province may impose a tax on business enjoying a franchise at a rate not exceeding 50% of 1% of the gross annual receipts of the preceding calendar year based on the incoming receipt or realized within its territorial jurisdiction. In the case of a newly started business, the tax shall not exceed 1/20th of 1% of the capital investment in the succeeding calendar year. Regardless of when the business started to operate, the tax shall be based on the gross receipts of the preceding calendar year, or any fraction thereof, as provided herein. Section 151, Scope of Taxing Powers. Except as otherwise provided in this code, the city may levy the taxes, fees, and charges which the province or municipality may impose, provided, however, that the taxes, fees, and charges levied and collected by highly urbanized and independent component cities shall accrue to them and distributed in accordance with the provisions of this code. The rates of taxes that the city may levy may exceed the maximum rates allowed for the province or municipality by not more than 50%, except the rates of professional and amusement taxes. Taxes are the lifeblood of the government, for without taxes the government can neither exist nor endure. A principal attribute of sovereignty, the exercise of taxing power derives its source from the very existence of the state whose social contract with its citizens oblige it to promote public interest and common good. The theory behind the exercise of the power to tax emanates from necessity. Without taxes, government cannot fulfill its mandate of promoting the general welfare and well-being of the people. In recent years, the increasing social challenges of the times expanded the scope of state activity, and taxation has become a tool to realize social justice and the equitable distribution of wealth, economic progress, and the protection of local industries as well as public welfare and similar objectives. Taxation assumes even greater significance with the ratification of the 1987 Constitution. Thenceforth, the power to tax is no longer vested exclusively on Congress. Local legislative bodies are now given direct authority to levy taxes, fees, and other charges, pursuant to Article 10, Section 5 of the 1987 Constitution. Section 5. Each local government unit shall have the power to create its own sources of revenue, to levy taxes, fees, and charges subject to such guidelines and limitations as the Congress may provide, consistent with the basic policy of local autonomy. Such taxes, fees, and charges shall accrue exclusively to the local governments. In the case at bar, Section 151, in relation to Section 137 of the LGC, clearly authorizes the respondent city government to impose on the petitioner the franchise tax in question. It is worth mentioning that Section 192 of the LGC empowers the LGUs, through ordinances duly approved, to grant tax exemptions, initiatives, or reliefs. But in enacting Section 37 of Ordinance Number 165-92, which imposes an annual franchise tax, notwithstanding any exemption granted by law or other special law, the respondent city government clearly did not intend to exempt the petitioner from the coverage thereof. As this court observed in the Macton case, the original reasons for the withdrawal of tax exemption privileges granted to government-owned or controlled corporations and all other units of government were that such privilege resulted in serious tax base erosion and distortions in the tax treatment of similarly situated enterprises. With the added burden of devolution, it is even more imperative for government entities to share in the requirements of development, fiscal or otherwise, by paying taxes or other charges due from them. PAL versus EDU, August 15, 1988. Philippine Airlines PAL is a corporation organized and existing under the laws of the Philippines and engaged in the air transportation business under a legislative franchise, Act No. 42739, as amended by Republic Act Numbers 25 and 269.1. Under its franchise, PAL is exempt from the payment of taxes. Sometime in 1971, however, Appellee Commissioner Romeo F. Elevate issued a regulation requiring all tax-exempt entities, among them PAL, to pay motor vehicle registration fees. PAL paid under protest the registration fees amounting to 19,529.75, and through counsel wrote a letter dated May 19, 1971 to Commissioner EDU demanding a refund of the amounts paid, invoking the ruling in Calalang versus Lorenzo, where it was held that motor vehicle registration fees are in reality taxes from the payment of which PAL is exempt by virtue of its legislative franchise. EDU denied the request for refund on the ground that motor vehicle registration fees are regulatory exceptional and not revenue measures, and therefore do not come within the exemption granted to PAL. The trial court rendered the decision dismissing the appellant's complaint. PAL appealed to the Court of Appeals, which certified the case to the Supreme Court. Issue: whether registration fees as to motor vehicle are taxes to which PAL is exempted. It is quite apparent that vehicle registration fees were originally simple exceptional, intended only for rigidly purposes in the exercise of the state's police powers. Over the years, however, as vehicular traffic exploded in number and motor vehicles became absolute necessities without which modern life as we know it would stand still, Congress found the registration of vehicles as a very convenient way of raising much needed revenues without changing the earlier deputy of registration payments as fees. Their nature has become that of taxes. In view of the foregoing, we ruled that motor vehicle registration fees, as at present exacted pursuant to the Land Transportation and Traffic Code, are actually taxes intended for additional revenues, of government, even if 1/5 or less of the amount collected is set aside for the operating expenses of the agency administering the program. So, may the respondent administrative agency be required to refund the amount stated in the complaint of PAL? The answer is no. The claim for refund is made for payments given in 1971. It is not clear from the records as to what payments were made in succeeding years. We have ruled that Section 24 Republic Act No. 5448 dated June 27, 1968 repealed all earlier tax exemptions of corporate taxpayers found in legislative franchise similar to that invoked by PAL in this case. Any registration fees collected between June 27, 1968 and April 9, 1979 were correctly imposed because the tax exemption in the franchise of PAL was repealed during that period. However, an amended franchise was given to PAL in 1979, Section 13 of Presidential Decree No. 1590, that provides, in consideration of the franchise and rights hereby granted, the grantee shall pay to the Philippine government during the lifetime of this franchise whichever of subsections A and B hereunder will result in a lower taxes. A. The basic corporate income tax based on the grantee's annual net taxable income computed in accordance with the provisions of the Internal Revenue Code, or B. A franchise tax of 2% of the gross revenues derived by the grantees from all specific, without distinction as to transport or non-transport corporations, provided that with respect to international air transport service, only the gross passengers, mail, and freight revenues from its outgoing flight shall be subject to this law. The tax paid by the grantee under either of the above alternatives shall be in lieu of all other taxes, duties, royalties, registration, license, and other fees and charges of any kind, nature, or description imposed, levied, established, assessed, or collected by any municipal, city, provincial, or national authority or government agency, now or in the future, including but not limited to the following. PAL's current franchise is clear and specific. It has removed the ambiguity found in the earlier law. PAL is now exempt from the payment of any tax, fee, or other charge on the registration and licensing of motor vehicles. Such payments are already included in the basic tax or franchise tax provided in subsections A and B of Section 13 PD 1590 and may no longer be exacted. Wherefore, the petition is hereby partially granted. The prayed for refund of registration fees paid in 1971 is denied. The Land Transportation Franchising and Regulatory Board is enjoined functions the collecting of any tax, fee, or other charge on the registration and licensing of petitioners' motor vehicles from April 9, 1979, as provided in Presidential Decree number 1590. DIAZ versus VIDEOGRAM 151 SQA 208 or GR L75697. Facts. The petitioner assails the validity of PD 1987 entitled An Act Creating the Videogram Regulatory Board, citing Section 10, which imposes a tax of 30% gross receipts payable to the local government. Petitioner contends that aside from its being a writer and not germane to the subject matter thereof, and such imposition was being harsh, confiscatory, oppressive, and or unlawfully restrains trade in violation of the Due Process Clause of the Constitution. Issue: whether PD 1987 is a valid exercise of the taxing power of the state. The tax does not cease to be valid merely because it regulates, discourages, or even definitely deters the activities taxed. The power to impose taxes is one so unlimited in force and so searching in extent that the courts scarcely venture to declare that it is subject to any restrictions whatever, except such as rest in the discretion of the authority which exercises it. In imposing a tax, the legislature acts upon its constituents. This is, in general, a sufficient security against erroneous and oppressive taxation. The tax imposed by the decree is not only a regulatory, but also a revenue measure prompted by the realization that earnings of videogram establishment of around 600 million per annum have not been subjected to tax, thereby depriving the government of an additional source of revenue. It is an end-user tax imposed on retailers for every videogram they make available for public viewing. It is similar to the 30% amusement tax imposed or borne by the movie industry, which the theater owners pay to the government, but which is passed on the entire cost of the admission ticket, thus shifting the tax burden on the buying or the viewing public. It is a tax that is imposed uniformly on all videogram operators. The levy of the 30% tax is for public purpose. It was imposed primarily to answer the need regulating the video industry, particularly because of the rampant film piracy, the flagrant violation of intellectual property rights, and the proliferation of pornographic videotapes. And while it was also an objective of the decree to protect the movie industry, the tax remains a valid imposition. The public purpose of a tax may legally exist even if the motive which impelled the legislature to impose tax was to favor one industry over another. It is inherent in the power to tax that a state be free to select the subjects of taxation, and it has been repeatedly held that inequities which result from a singling out of one particular class for taxation or exemption infringe no constitutional limitation. Taxation has been made the implement of the state's police power. At bottom, the tax rate is a matter better addressed to the taxing legislature. LUTZ versus ARANETA. Facts: Plaintiff Walter Lutz, in his capacity as judicial administrative of the intestate estate of Antonio Ledesma, seeks to recover from the collector of internal revenue the sum of 14,666.40 paid by the estate as taxes under Section 3 of the Act for the years 1948, 1949, and 1950. Alleging that such tax is unconstitutional and void, being levied for the aid and support of the sugar industry exclusively, which is, in Lutz's opinion, is not a public purpose for which a tax may be constitutionally levied. Issue: whether the imposition of taxes are valid. The basic defect in the plaintiff's position is our assumption that the tax provided for in Commonwealth Act No. 567 is a pure exercise of the taxing power. Analysis of the Act, and particularly of Section 6, will show that the tax is levied with a regulatory purpose to provide means for this rehabilitation and stabilization of the threatened sugar industry. In other words, the Act is primarily an exercise of the police power. This court takes judicial notice of the fact that sugar production is one of the great industries of our nation, sugar occupying a leading position among its export products, that it gives employment to thousands of laborers in fields and factories, that it is a great source of the state wealth, is one of the important sources of foreign exchange needed by our government, and is thus pivotal in the plans of a regime committed to a policy of currency stability. Its promotion, protection, and advancement therefore redounds greatly to the general welfare. Hence, it was competent for the legislature to find that the general welfare demanded that the sugar industry should be stabilized in turn, and in the wide field of its police power, the law-making body could provide that the distribution of benefits therefrom be readjusted among its components to enable it to resist the added strain of the increase in taxes that it had to sustain. Even from the standpoint that the Act is a pure tax measure, it cannot be said that the devotion of tax money to experimental stations to seek increase of efficiency in sugar production, utilization or byproducts, and solution of allied problems, as well as to the improvements of living and working conditions in sugar mills or plantations, without any part of such money being channeled directly to private persons, constitutes expenditure of tax money to private purposes. CIR versus Central Drug LUZON Corporation. Facts: Respondent is a domestic corporation engaged in the retail of medicines and other pharmaceutical products. In 1997, it operated 8 drugstores under the business name and style Mercury Drug. Pursuant to the provisions of RA 7432 and Revenue Regulation Number RR 297 issued by the Bureau of Internal Revenue, Respondent granted 20% sales discount to qualified senior citizens on purchases of medicines covering the calendar year 1997. The sales discount granted to senior citizens totaled 2,798,508. On April 15, 1998, Respondent filed its 1997 corporate annual income tax return, reflecting a net income tax liability due to a net loss incurred from business operations of $2,405,140. Respondent filed its 1997 income tax return under protest. On 19 March 1999, respondent filed with the petitioner a claim for refund for the credit of overpaid income tax for the taxable year 1997 in the amount of $2,660,829. Respondent alleged that the overpaid tax was the result of the wrongful implementation of RA 7432. Respondent treated the 20% sales discount as a deduction from gross sales in compliance with RR 2-94 instead of treating it as a tax credit as provided under Section 4, letter A of RA 7432. On April 6, 2000, respondent filed a petition for review with the CTA in order to toll the running of the 2-year statutory period within which to file a judicial claim. Respondent reasoned that RR 2-94, which is a mere implementing administrative regulation, cannot modify, alter, or amend the clear mandate of RA 7432. Consequently, Section 2, letter I of RR 2-94 is without force and effect for being inconsistent with the law it seeks to implement. In his answer, petitioner stated that the construction given to a statute by a specialized administrative agency like the BIR is entitled to great respect and should be accorded great weight. When RA 7432 allowed senior citizens discount to be claimed as tax credit, it was silent as to the mechanics of availing the same. For clarification, the BIR issued RR 2-94 and defined the term tax credit as a deduction from the establishment's gross income and not from its tax liability in order to avoid an absurdity that is not intended by the law. The ruling of the Court of Tax Appeals. On 15 April 2002, the CTA rendered a decision ordering petitioner to issue a tax credit certificate in the amount of $2,376,805.63 in favor of respondent. The CDA stated that in a number of analogous cases, it has consistently ruled that the 20% senior citizens discount should be treated as tax credit instead of a mere deduction, gross income. In quoting its previous decision, the CDA ruled that RR 2-94 engraved a new meaning to the phrase tax credit as deductible from gross income, which is a deviation from the plain intendment of the law. An administrative regulation must not contravene but should conform to the standards that the law prescribes. The CDA also ruled that respondent has properly substantiated its claim for tax credit by documentary evidence. However, based on the examination conducted by the Commission Independent Certified Public Accountant (CPA), there were some material discrepancies due to missing cash slips, lack of senior citizens' ID number, failure to include the cash slips in the summary report, and vice versa. Therefore, between the summary report presented by the respondent and the audited amount presented by the independent CPA, the CDA deemed it proper to consider the lesser of two amounts. Aggrieved by the CDA's decision, petitioner elevated the case before the Court of Appeals. The ruling of the Appellate Court. The Court of Appeals disagreed with petitioner's contention that the CDA's decision applied a literal interpretation of the law. It reasoned that under the verbalized rule, if the statute is clear, plain, and free from ambiguity, it must be given its literal meaning and applied without interpretation. This principle rests on the presumption that the words used by the legislature in a statute correctly express its intent and preclude the court from constructing it differently. The CA distinguished tax credit as an amount subtracted from a taxpayer's total tax liability to arrive at the tax due, while a tax deduction reduces the taxpayer's taxable income upon which the tax liability is computed. A credit differs from deduction in that the former is subtracted from tax while the latter is subtracted from income before the tax is computed. Issues raised to the Supreme Court. Petitioner raises two issues: whether the appellate court erred in holding that respondent may claim the 20% senior citizen sale discount as a tax credit deductible from future income tax liabilities instead of a mere deduction from gross income or gross sales, and two, whether the appellate court erred in holding that respondent is entitled to a refund. The ruling of the court. The petition lacks merit. The issues presented are not novel. In two similar cases involving the same parties, where respondent lodged its claim for tax credit on the senior citizens discount granted in 1995 and 1996, This court has clearly ruled that the 20% senior citizens discount required by RA 7432 may be claimed as a tax credit and not merely a tax deduction from gross sales or gross income. Under RA 7432, Congress granted the tax credit benefit to all covered establishments without conditions. The net loss incurred in a taxable year does not preclude the grant of tax credit because by its nature, the tax credit may still be deducted from a future, not a present, tax liability. However, the senior citizens discount granted as a tax credit cannot be refunded. The tax credit may still be deducted from a future, not a present, tax liability. The court stressed that prior payment of tax liability is not a precondition before a taxable entity can avail of the tax credit. The court declared where there is no tax liability or where a private establishment reports a net loss for the period, the tax credit can be availed of and carried over to the next taxable year. It is irrefutable that under RA 7432, Congress has granted a tax credit benefit to all covered establishments without conditions. Therefore, neither a tax liability nor a prior tax payment is required for the existence of or grant of a tax credit. The applicable law on this point is clear and without any qualification. The senior citizens discount may be claimed as a tax credit and not a refund. If the words of the law are clear, plain, and free of ambiguity, it must be given its literal meaning and applied without any interpretation. Hence, the senior citizens discount may be claimed as a tax credit and not as a refund. RA 9257 now specifically provides that all covered establishments may claim the senior citizens discount as tax deduction. Contrary to the provisions of RA 7432, where the senior citizens discount granted by all covered establishments can be claimed as tax credit, RA 9257 now specifically provides that this discount should be treated as tax deduction. With the effectivity of RA 9257 on 21st March 2004, there is now a new tax treatment for senior citizens discount granted by all covered establishments. This discount should be considered as a deductible expense from gross income and no longer as tax credit. The present case, however, covers the taxable year 1997 and is thus governed by the old law, RA 7432. DIAZ and Timbal, petitioners versus Secretary of Finance. July 19, 2011, GR 193007. Facts. Petitioners Renato Diaz and Aurora Timbal filed this petition for declaratory relief assailing the validity of the impending imposition of value-added tax by the Bureau of Internal Revenue on the collections of tollway operators. Petitioners hold the view that Congress did not, when it enacted the NIRC, intend to include toll fees within the meaning of sales of services that are subject to VAT, that a toll fee is a user's tax, not a sale of service, that to impose VAT on toll fees would amount to a tax on public service, and that since VAT was never factored into the formula for computing toll fees, its imposition would violate the non-impairment clause of the Constitution. On August 13, 2010, the court issued a temporary restraining order enjoining the implementation of VAT. The court required the government, represented by respondents Cesar Purisima, Secretary of the Department of Finance, and Kim Jacinto Henares, Commissioner of Internal Revenue, to comment on the petition within 10 days from notice. Later, the court issued another resolution treating the petition as one for prohibition. On August 23, 2010, the Office of the Solicitor General filed the government's comment. The government avers that the NIRC imposes VAT on all kinds of services of franchise grantees, including tollway operations, except where the law provides otherwise, that the court should seek the meaning and intent of the law from the words used in the statute, and that the imposition of VAT on tollway operations has been the subject as early as 2003 of several BIR rulings and circulars. The government also argues that petitioners have no right to invoke the non-impairment of contracts clause, since they clearly have no personal interest in existing toll operating agreements between the government and tollway operators. At any rate, the non-impairment clause cannot limit the state's sovereign taxing power, which is generally read into contracts. Finally, the government contends that the non-inclusion of VAT in the parametric formula for computing toll rates cannot exempt tollway operators from VAT. In any event, it cannot be claimed that the rights of tollway operators to a reasonable rate of return will be impaired by the VAT since this is imposed on top of the toll rate. Further, the imposition of VAT on toll fees would have very minimal effect on motorists using the tollways. In their reply to the government's comment, petitioners point out that tollway operators cannot be regarded as franchise grantees under the NIRC since they do not hold legislative franchises. Further, the BIR intends to collect the VAT by rounding off the toll rate and putting any excess collection in an escrow account. But this would be illegal since only the Congress can modify VAT rates and authorize its disbursement. Finally, BIR Revenue Memorandum Circular 63/2010, which directs all toll companies to record an accumulated input VAT of zero balance in their books as of August 16, 2010, contravenes Section 111 of the NIRC, which grants entities that become liable to VAT a transitional input tax credit of 2% on beginning inventory. For this reason, the VAT on toll fees cannot be implemented. The issues presented. The case presents two procedural issues: whether or not the court may treat the petition for declaratory relief as one for prohibition, and two, whether or not petitioners DIAZ and Timbol have legal standing to file the action. The case also presents two substantive issues: whether or not the government is unlawfully expanding VAT coverage by including tollway operators and tollway operations in the term franchise grantees and sale of services under Section 108 of the Code, and number two, whether or not the imposition of VAT on tollway operators A. amounts to a tax on tax and not a tax on services, B. will impair the tollway operators' right to reasonable return of investment under their TOAs, and C. is not administratively feasible and cannot be implemented. The court's ruling on the procedural issues. The court issued a resolution treating the petition as one of the prohibition rather than one of declaratory relief. The characterization that petitioners DIAZ and Timbol gave their action. The government has sought reconsideration of the court's resolution, however, arguing that petition allegations clearly made out a case for declaratory relief, an action over which the court has no original jurisdiction. The government adds, moreover, that the petition does not meet the requirements of Rule 65 of actions for prohibition since the BIR did not exercise judicial, quasi-judicial, or ministerial functions when it sought to impose VAT on toll fees. Besides, petitioners DIAZ and Timbol has a plain, speedy, and adequate remedy in the ordinary course of law against the BIR action in the form of an appeal to the Secretary of Finance. But there are precedents for treating a petition for declaratory relief as one for prohibition if the case has far-reaching implications and raises questions that need to be resolved for the public good. The court has also held that a petition for prohibition is a proper remedy to prohibit or nullify acts of executive officials that amount to usurpation of legislative authority. Although the petition does not strictly comply with the requirements of Rule 65, the court has ample power to waive such technical requirements when the legal questions to be resolved are of great importance to the public. The same may be said of the requirement of locus standi, which is a mere procedural requisite. On the substantive issues, 1. The relevant law in this case is Section 108 of the NIRC as amended. VAT is levied, assessed, and collected according to Section 108 on the gross receipts derived from the sale of exchange of services as well as from the use of lease of properties. The third paragraph of Section 108 defines sale or exchange of service as follows. The phrase sale or exchange of services means the performance of all kinds of services in the Philippines for a fee, remuneration, or consideration, including those performed or rendered by construction and service contractors, stock, real estate, commercial, customs and immigration brokers, lessors of property, whether personal or real, warehousing services, lessors or distributors of cinematographic films, persons engaged in milling, processing. This means that services to be subject to VAT need not fall under the traditional concept of services, the personal or professional kinds that require the use of human knowledge and skills. And not only do tollway operators come under the broad term all kinds of services, they also come under the specific class described in Section 108 as all other franchise grantees who are subject to VAT, except those under Section 119 of this code. Tollway operators are franchise grantees and they do not belong to exceptions. The low-income radio or television broadcasting companies with gross annual incomes of less than 10 million and gas and water utilities at Section 1119 spares from the payment of VAT. The word franchise broadly covers government grants of a special right to do an act or series of acts of public concern. Businesses of a public nature such as public utilities and the collection of tolls or charges for its use or service is a franchise. 2. Petitioners argue that a toll fee is a user's tax, and to impose VAT on toll fees is tantamount to taxing a tax. Actually, petitioners based this argument on the following discussions in Manila International Airport Authority versus Court of Appeal. No one can dispute that properties of public dominion mentioned in Article 420 of the Civil Code, like roads, canals, rivers, torrents, ports, and bridges constructed by the state, are owned by the state. The term ports includes seaports and airports. The MIA airport lands and buildings constitute a port constructed by the state. Under Article 420 of the Civil Code, the MIA airport lands and buildings are properties of public dominion and thus owned by the state or the Republic of the Philippines. Petitioners assume that what the court said above, equating terminal fees to a user's tax, must also pertain to tollway fees, but the main issue in the MIA case was whether or not Paranaque City could sell airport lands and buildings under MIA administration of public auction to satisfy unpaid real estate taxes, since local governments have no power to tax the national government. The court held that the city could not proceed with the auction sale. MIA forms part of the national government, although not integrated in the department framework. Thus, its airport lands and buildings are properties of public dominion beyond the commerce of man under Article 420 of the Civil Code and could not be sold at public auction. As can be seen, the discussion in the MIA case on toll roads and toll fees was made not to establish a rule that tollway fees are user tax, but to make the point that airport lands and buildings are properties of public dominion, and that the collection of terminal fees for their use does not make them private properties. Tollway fees are not taxes. Indeed, they are not assessed and collected by the BIR and do not go to the general coffers of the government. In sum, fees paid by the public to tollway operators for use of the tollways are not taxes in any sense. A tax is imposed under the taxing power of the government, principally for the purpose of raising revenue to fund public expenditures. Toll fees, on the other hand, are collected by private tollway operators as reimbursement for the costs and expenses incurred in the construction, maintenance, and operation of the tollways, as well as to assure them a reasonable margin of income. Although toll fees are charged for the use of public facilities, therefore, they are not government exactions that can be properly treated as tax. Taxes may be imposed only by the government under its sovereign authority. Toll fees may be demanded by either the government or private individuals or entities as an attribute of ownership. Parenthetically, VAT on tollway operations cannot be deemed as tax on tax due to the nature of VAT as an indirect tax. In indirect taxation, a distinction is made between the liability for the tax and burden of the tax. The seller, who is liable for the VAT, may shift or pass on the amount of VAT it paid on goods, properties, or services to the buyer. In such a case, what is transferred is not the seller's liability but merely the burden of the VAT. Consequently, VAT on tollway operations is not really a tax on the tollway user, but on the tollway operator. Under Section 105 of the Code, VAT is imposed on any person who, in the course of trade or business, sells or renders services for a fee. In other words, the seller of services, who in this case is the tollway operator, is the person liable for VAT. The latter merely shifts the burden to VAT to the tollway user as part of the toll fees. For this reason, VAT on tollway operations cannot be a tax on tax, even if toll fees were deemed as a user's tax. 3. Petitioner Timbol has no personality to invoke the non-impairment of contract clause on behalf of private investors in the tollway projects. She will neither be prejudiced by nor be affected by the alleged diminution in return of investment that may result from the VAT imposition. She has no interest at all in the profits to be earned under the TOAs. The interest in and right to recover investment solely belongs to the private tollway investors. Conclusion. The Commissioner of Internal Revenue did not usurp legislative prerogative or expand the VAT law's coverage when she sought to impose VAT on tollway operations. Section 108, letter A of the Code clearly states that services of all other franchise grantees are subject to VAT, except as may be provided under Section 119 of the Code. Tollway operators are not among the franchise grantees subject to franchise tax Under the latter provision, neither are there services among the VAT-exempt transactions under Section 109 of the Code. If the legislative intent was to exempt tollway operations from VAT, as petitioners so strongly allege, then it would have been well for the law to clearly say so. Tax exemption must be justified by clear statutory grant and based on language in the law too plain to be mistaken. But as the law is written, no such exemption obtains for tollway operators. The court is thus duty-bound to simply apply the law as it is found. Lastly, the grant of tax exemption is a matter of legislative policy that is within the exclusive prerogative of Congress. The court's role is to merely uphold the legislative policy as reflected first and foremost in the language of tax statute. Thus, any unwarranted burden that may be perceived to result from enforcing such policy must be properly referred to Congress. The court has no discretion on the matter but simply applies the law. Planters Products Incorporated, or PPI, versus FERTIPHIL. Facts. The petitioner and private respondent are private corporation incorporated under Philippine laws. Both engage in the importation and distribution of fertilizers, pesticides, and agricultural chemicals. On January 3, 1985, President Marcos issued Letters of Instruction number 1465, which provided for the imposition of a capital recovery component on the domestic sale of all grades of fertilizer. Pursuant to the Letters of Instruction, the respondent paid 10 pesos per every bag of fertilizer it sold in the domestic market to the Fertilizer and Pesticide Authority, or FPA. Thus, FPA remits the amount collected to the Far East Bank and Trust Company, the depository bank of the petitioner, the sum of 1,689,144. After the 1986 EDSA revolution, FPA voluntarily stopped the imposition of the 10 pesos levy. Thus, respondent demanded from petitioner a refund of the amount remitted, but the latter refused. Therefore, respondent filed a complaint for collection and damages, questioning the constitutionality of Letters of Instruction number 1465. Hence, this petition issue whether LOI number 1465 is constitutional or valid. The 10 pesos levy under LOI number 1465 is too excessive to serve a mere regulatory purpose. The levy, no doubt, was a big burden on the seller or the ultimate consumer. It increased the price of a bag of fertilizer by as much as 5%. A plain reading of the LOI also supports the conclusion that the levy was for revenue generation. The LOI expressly provided that the levy was imposed until adequate capital is raised to make PPI viable. Taxes are enacted only for a public purpose. The 10 peso levy is unconstitutional because it was not for a public purpose. The levy was imposed to give undue benefit to PPI. An inherent limitation in the power of taxation is public purpose. Taxes are exacted only for a public purpose. They cannot be used for purely private purposes or for the exclusive benefit of private persons. The reason for this is simple. The power to tax exists for the general welfare. Hence, implicit in its power is the limitation that it should be used only for a public purpose. It would be a robbery for the state to tax its citizen and use the funds generated for a private purpose. As an old United States case bluntly put it, to lay with one hand the power of the government on the property of the citizen, and with the other to bestow it upon favored individuals to aid private enterprises and build up private fortunes is nonetheless a robbery because it is done under the forms of law and is called taxation. The LOI is still unconstitutional even if it enacted under the police power. It did not promote public interest. Even if we consider LOI number 1695 enacted under the police power of the state, it would still be invalid for failing to comply with the test of lawful subjects and lawful means. Jurisprudence states that the test as follows: 1. The interest of the public generally, as distinguished from those of particular class, requires its exercise, and 2. The means employed are reasonably necessary for the accomplishment of the purpose and not unduly oppressive upon individuals. For the same reason as discussed, LOI number 1695 is invalid because it did not promote public interest. The law was enacted to give undue advantage to a private corporation. We quote with approval the CA rationalization in this point. The general rule is that an unconstitutional law is void. The doctrine of operative fact is inapplicable. PPI argues that FERTIPHIL cannot seek a refund even if LOI 1465 is declared unconstitutional. It banks on the doctrine of operative fact, which provides that an unconstitutional law has an effect before being declared unconstitutional. PPA wants to retain the levies paid under LOI number 1465, even if it is subsequently declared to be unconstitutional. We cannot agree. It is settled that no question, issue, or argument will be entertained on appeal unless it has been raised in the court of quo. PPI did not raise the applicability of the doctrine of operative fact with the RTC and the CA. It cannot belatedly raise the issue with us in order to extricate itself from the dire effects of an unconstitutional law. At any rate, we find the doctrine inapplicable. The general rule is that an unconstitutional law is void. It produces no rights, imposes no duties, and affords no protection. It has no legal effect. It is in legal contemplation, inoperative, as if it has not been passed. Being void, FERTIPHIL is not required to pay the levy. All levies paid should be refunded in accordance with the General Civil Code principle against unjust enrichment. The general rule is supported by Article 7 of the Civil Code. Article 7. Laws are repealed only by subsequent ones, and their violation or non-observance shall not be excused by disuse or custom or practice to the contrary. When the courts declare a law to be inconsistent with the Constitution, the former shall be void and the latter shall govern. The doctrine of operative fact, as an exception to the general rule, only applies as a matter of equity and fair play. It nullifies the effects of an unconstitutional law by recognizing that the existence of a statute prior to the determination of unconstitutionality is an operative fact and may have consequences, which cannot always be ignored. The past cannot always be erased by a new judicial declaration. The doctrine is applicable when a declaration of unconstitutionality will impose an undue burden on those who have relied on the invalid law. Thus, it was applied to a criminal case when a declaration of unconstitutionality would put the accused in double jeopardy, or would put in limbo the acts done by a municipality in reliance upon the law creating it. Here, we do not find anything iniquitous in ordering PPI to refund the amounts paid by FERTIPHIL under LOI number 1465. It unduly benefited from the levy. It was proven during the trial that the levies paid were remitted and deposited to its bank account. Quite the reverse, it would be inequitable and unjust not to order a refund. To do so would unjustly enrich PPI at the expense of FERTIPHIL. Article 22 of the Civil Code explicitly provides that every person who, through an act of performance by another, comes into possession of something at the expense of the latter, without just or legal ground, shall return the same to him. We cannot allow PPI to profit from an unconstitutional law. Justice and equity dictate that PPI must refund the amounts paid by FERTIPHIL. Wenceslao Pascual, in his official capacity as Provincial Governor of Rizal, versus the Secretary of Public Works and Communication, et al. Facts. The petitioner instituted an action for declaring a declaratory relief with injunction upon the ground that RA number 920 entitled An Act Appropriating Funds for Public Works, approved thus in Section 1, C, letter A thereof, an item of 85,000 for the construction, reconstruction, repair, extension, and improvement of Pasig feeder road terminals, whereas at that time the aforementioned feeder roads were nothing but projected and planned subdivisions roads, not yet constructed. Further, the projected feeder roads do not connect any government property or any important premises to the main highway. The contention of the respondents is that there is public purpose because people living in that subdivision will directly be benefited from the construction of the roads, and the government also gains from the donation of the land supposed to be occupied by the streets made by its owner to the government. Hence this petition. Issue: whether the appropriation of the public funds by the respondent is for a public purpose. Ruling: no. The court ruled the respondents appropriated the public funds for a private purpose. It is a general rule that the legislature is without power to appropriate public revenue for anything but a public purpose. Thus, the test of the constitutionality of a statute requiring the use of public funds is whether the statute is designed to promote the public interest, as opposed to the furtherance of the advantages of individuals, although each advantage might incidentally serve the public. Hence, in accordance with the rule that taxing power must be exercised for public purpose only and not for the advantage of private individuals. Further, the petitioner is a provincial governor, which officially represents the province of Rizal, is most populated with political subdivision, and the taxpayers therein bear a substantial portion of the burden of taxation, whereas the circumstances surrounding this sufficiently justify the latter's action in contesting the appropriation and donation in question.